Hey, good morning. This is Mayor Valensky with Driving Markets, driving while talking about markets. Everything said in this piece is for media publication only. It's not investment advice, not financial advice, etc., etc. Let's get kicking off. Let's see what is driving markets today. Okay, so on Friday, the US markets and European markets closed down because the PPI, the Producer Price Index, which is the wholesale measure of inflation in the US. In other words, it is the inflation measure at producer level, not at the consumer level, came in higher than expected. If you recall, on driving markets, I've been saying for a while, I don't believe inflation is going to go down. There's an undercurrent there of inflation which is bubbling along. It might have had a drop over a month or 2 month period, and even going forward they're expecting inflation to go down, but I'm going to be contrary to what the analysts and the general banking sector believe, and I think actually inflation is going to go up. Now, a lot of people are saying on the back of what, why would you say inflation is going to go up when oil's going to go down and the cost of housing is going down, which are two major components of the inflation measure. The reason why I believe inflation is going to go up, because I think the general cost of living, the everyday food factor and the energy factor and overall other factors are going to push prices much higher. So even though housing may come down, which is a major component, at the producer level, the raw material level, that's going to feed through to CPI, Consumer Price Index, which is retail inflation. So you can expect in 2023 for inflation to rise further. I put my neck on the line here, and I'm stating that it's probably going to go into double digits in the States. It's already double digits in the UK and effectively in Europe. So it's going to rise even further when we're looking at the numbers in 2023. Also, as a result of that, I think interest rates are going to go higher in the US and in Europe and in the UK. This week, you've got several factors and several measures that will give us another indicator as to where we're at regarding inflation. You've got CPI coming out this week, Consumer Price Index, and that's coming out on Tuesday. That's the Consumer Price Index in the States. You've got an interest rate decision on Wednesday in the UK, and you've got an interest rate decision in Europe. Both of them are going to be raising interest rates, according to the consensus of opinion, by 50 basis points. So the UK is going to go to 3.5%, and the ECB is going to raise it by 50 basis points to 2.5%. The ECB, or the Europeans, are well behind the curve on inflation, and 2.5% is simply not enough in order to combat and battle inflation. So they're going to have to increase their interest rates significantly. And then on Tuesday, Wednesday, you've got the FOMC, the Federal Open Market Committee meeting, which meets, and then again, consensus of opinion is a 50 basis point rise. However, with the ISM coming in last week, the Institute of Supply Management, higher than expected, which again shows the overall health of the US economy, and PPI coming in higher than expected, then there is a chance, a 25 to 30% chance, that they're going to raise it by 75 basis points. I myself think they're probably going to raise it by 50 basis points in December, and another 50 basis points come January 2023. Now, the big talk last week, it started at the beginning of the week, was recession. In fact, recession was talked about on a daily basis on all media channels and all news channels, because the question is has the Fed gone too far in raising interest rates, and is that going to cause a recession? Well, it could cause a recession. There effectively is a recession as far as I'm concerned, even though the official numbers, the GDP numbers, don't reflect that. But in terms of what you feel in business and what you feel out there with the cost of living, it feels like a recession. It looks like a recession, and therefore sounds like a recession, so it must be a recession. But official government figures in the US and in Europe and the UK are not reflecting that. They're still showing a slight growth when it comes to the numbers of measuring recession. So reality on the street there is, but the official numbers are not reflecting it, and the banks are worried that officially next year we're going to go into recession. Now, recession would mean effectively layoffs as far as employment's concerned, and if there's layoffs as far as employment is concerned, then that's going to impact on obviously corporate earnings, because there's going to be more people unemployed and less money floating around in the consumer sector in order to buy the goods of those said corporates. So that's going to have a big impact. As far as Tesla's concerned, interesting, Elon Musk, he's going to have to leverage or gear up on some of his paper, some of his shares, in order to take a loan. It's actually going to take a loan supported by, guaranteed by his shares in Tesla to further finance Twitter, because it's costing a huge amount of money, not only to purchase Twitter, but also to the running costs and the financing of it. So he's going to have to leverage his shares. Now, normally you'd say, well, he's worth so much money, he's the richest guy in the world. Why does he just pay the money in? There's a difference between having assets and having investments with having liquid cash in the bank. And most CEOs and most rich people and most billionaires, that are rich in assets, but they're not necessarily rich in cash. He's going to have to raise the cash in order to continuously fund Twitter. Eventually, it's going to be successful. I've got complete faith in Elon Musk, because he is one of the, if not the number one CEO, director, innovative, as I've said all along. But there is a cash flow issue, and that's one of the indicators in overall global markets. There is a cash flow issue. There is a liquidity issue when it's coming to financial markets, and that's going to impact all asset classes in 2023. Regarding foreign exchange, which I must raise, the dollar is slightly stronger this week, even though I do believe its upside is limited. But it was a bit stronger against the euro and against the yen. I don't see the euro getting much stronger at this level. I see the pound getting stronger, by the way, running up to 125, 127 is the range in the near term, and then we'll see what happens in 2023. But the pound I'm pretty bullish on the pound, so it looks like it's going to go up a bit further. As far as asset classes like cryptos, you know my opinion on that. Bitcoin is going to go below 15,000. Bonds have creeped up a little bit, but come well off the highs. So the US Treasury is at 3.59. That's also indicating that interest rates will not go up in the near future. Otherwise, that would have shot up dramatically. As far as gold's concerned, running around about the 1800 level. There's a resistance at 1820, so it could float up to above 1800 to 1820, and then come all the way back down to 1720, unless there's something dramatic happens as far as that's concerned. Regarding property, there'll be a continuous fall in property in 2023. I'm looking at a 25 to 30% fall in property in 2023. And this is Mayor Valensky with Driving Markets. Have a good day.